How do you plan for the unexpected in retirement? When we build retirement income plans, retirement investing plans, we have to start with some assumptions around things like how much we're going to spend throughout our retirement, how long we're going to live through retirement, and what we think our investment returns are going to be over that period. But anyone with any experience investing in capital markets and things like equities and fixed income knows that returns can vary even quite a bit over different time periods, both day to day, year to year, and even decade to decade. In this video, I'm going to walk through how you can stress test your retirement plan against some of these different return sequences and events that might unfold throughout your retirement. I'm going to explain the impact of volatile returns on a retirement investment portfolio. And I'm going to talk about some tools that you can use to measure the impact of different markets and different circumstances on your investment portfolio through retirement. And then we're going to close the video with some discussion around how you can use these insights to make decisions that'll help you along your retirement journey. And if we haven't met yet, my name is Mark Walhout. I run an investment advisory and financial planning business called Walhout Financial. I help people with retirement, and I created this channel to share ideas and concepts that I'm using to help people with retirement every single day. If you want to get more videos like these, consider subscribing to the channel and hit the bell icon so that you're alerted when new videos are posted. Leave me any questions or comments below. I always love getting questions. It gives me great ideas for videos that I can create in the future. And if you like this video, give it a thumbs up so that other people like you can find this video on their own. Anyone who has a lot of experience investing in capital markets over a long period of time knows that investment returns can vary quite a bit over periods of time, different periods of time. And to illustrate that, we're going to show a couple of examples, but we'll start with sort of a static return assumption or a static assumption about what we think investment returns are going to be, which I often do see in retirement plans that do come across my desk. Someone may assume, or a planner may assume, that they're going to get 5% annualized returns for a portfolio that's about 50% in equities and 50% in fixed income over the course of a person or a couple's retirement. And the problem with a flat, static assumption about what returns are going to be is that it may give us a false sense of security about the longevity and sustainability of our withdrawal plan. After all, we know that a portfolio of stocks and bonds won't always give you 5% returns every single year. They may average to be a 5% return over a long period of time, but we won't know that in advance, and we know that it won't be 5% every single year. And to help illustrate the point, I'm going to share an example or a couple of examples from history just to help illustrate the importance of acknowledging that those investment returns can be bumpy over long periods of time and what the impact of that might be on a retirement plan. So I'm going to go ahead and share my screen, and I'm going to show you a couple of different portfolios. We have two identical portfolios, both in 50% US equities and 50% US 5-year treasuries. The only difference between these two portfolios is that one portfolio started in 1969 and one portfolio started in 1979. So we'll start with the portfolio on the left-hand side. This one is for a hypothetical retiree who retired in 1979. Over the following 10 years, the ensuing 10 years, this portfolio delivered an annualized return of 14.73%. And as you can see from the chart, they enjoyed somewhat steady high returns. There was a blip in sort of the mid-late 80s, but by and large, they saw high and steady returns throughout that first decade of retirement. So somebody making regular withdrawals from a portfolio like this would have not only been able to sustain those withdrawals over that first decade quite easily, but they also would have seen the value of their wealth increase over that time frame. Now, take for another example, someone who retired 10 years earlier. And this is on the right-hand side of the chart, a different retiree who retired 10 years earlier, same portfolio, 50% US equities and 50% 5-year treasuries, US treasuries. That same investment portfolio had an annualized return over that time frame of 5.66%, which in and of itself isn't terrible from a nominal perspective, but inflation was also quite high through this period. And the portfolio saw a couple of very significant drawdowns over that first 10-year period. So the retiree who came out of this first decade of retirement in the face of these sort of middling returns, but also a couple of significant drawdowns and also regular withdrawals from the portfolio, after that first 10 years, they would have seen their portfolio depleted quite significantly, which would have created issues for them. Now, the good news is that we do have tools that do allow us to model out the impact of these different return sequences in our retirement. We don't know what the future is going to hold, but we can model out a whole bunch of different scenarios to see how our plan holds up in both good markets and bad markets. And now in the next phase of the video, I'm going to talk about and show you some of these tools in the context of a retirement plan so we can walk through these things together. So for the next phase of the video, we're going to reintroduce our favorite retirement couple, Janey and Janey, and we're going to look at their retirement plan and measure the impact of different market environments or different market sequences of returns over their plan. We're going to stress test their plan, and we're going to determine whether their plan is sustainable or if there are some adjustments that we might need to make in the face of a very bad sequence of returns in retirement. So I'm going to go ahead and share my screen with you, and we're going to take a look at Janey and Janey's plan. So we know that Janey and Janey have about $1.2 million saved up for retirement. They plan to spend about $6,500 per month. We expect they're going to live to around age 95. And we've assumed that their portfolio is going to return about 5.19% per year on an annual basis. And based on all this, the plan currently looks good. It looks like they're going to have enough savings to support them through retirement, in addition to the other income that they're going to get from Canada Pension Plan and Old Age Security. But all in all, things look good. It looks like they're on plan, on target to achieve that. But the one flaw, or one of the flaws with this particular approach to planning, is that we know that we're not going to get 5.19% every single year. Going back to the previous example, we know that a portfolio of equities and fixed income, a roughly balanced portfolio, will have different return sequences depending on what the future holds. And because we don't know what the future holds, it puts us in a difficult position. But we can stress test, or we can measure the impact of that volatility on the plan by throwing a whole bunch of simulated market environments at the plan, at the portfolio, to see how the plan holds up in the face of those different market environments. So I'm going to go ahead and go to the tab here called Stress Test, and we're going to do a volatility analysis on Janey and Janey's plan. And what you can see here, and I've already ran the volatility analysis for Janey and Janey for the existing plan, but what we can see is that for the first couple decades of their retirement, their plan looks pretty good. And what you're seeing in around 2045 or around their age 84, we start to see a certain amount or a number of the trials starting to fail. So we've thrown bear markets, bull markets, all sorts of different market environments at their plan, 1,000 different trials to be exact. And once they hit around age 84, we start to see a concerning number of these trials start to fail. And so you can see that as they age, as the years go on in their plan, the higher the likelihood is that they may run out of investment assets to support their lifestyle. More and more of the trials fail. And down here in the chart, you can see around 2045, that's sort of the earliest point at which, in the very, very worst case scenarios that are measured by the tool, they actually do run out of money. So Janey and Janey have some decisions to make. The first thing that they could do is they could simply just sort of wait and see what happens. I don't recommend this. I think that we should, at very minimum, have a discussion around, if these things unfold, what are we going to do? What are the responses going to be if we do have just an awful run of investment returns in retirement because we can't control what the market's going to do? What is the plan going to be? Being proactive with these things, I believe, is always the best approach. So what we did for Janey and Janey was we modeled out a couple of different things that they could do in order to improve the score on their stress test, improve their volatility analysis. So the first thing that we looked at was potentially, why don't we just consider starting retirement by spending a bit less? So let's reduce our planned spending in retirement by around 10% and see what the impact is on their stress test. And what we can see is that the plan, by just simply reducing our spending by 10% starting out in retirement, it gave us back a much better or much stronger result in the stress test. And that what that means is that by setting our spending expectations a bit lower to begin retirement and plan to continue that spending pattern throughout retirement, the impact of even very bad markets on the plan seem to still see the plan coming through to success in the vast majority of trials that were run against this plan. But let's say Janey and Janey have decided that they don't want to compromise their spending amount in retirement. They say, you know what, Mark, we've worked so hard and we have these plans for retirement. We do not want to even consider reducing our spending. So the other thing that they could do is they could look at potentially downsizing their home. So we looked at selling their home 15 years into retirement and buying a new home. So their current home is worth about $1 million. They're going to do a downsizing to a home that costs $800,000 that would free up some money that they could then use to support their lifestyle needs. So we can go ahead and recalculate the stress test of their plan under the assumption that they are downsizing their home slightly. And again, that's another strategy that they could use that would see them find a very successful result in their stress test. So these are just a couple of strategies that Johnny and Janey could proactively identify in advance and think about implementing in order to improve the result of the stress test that we ran on their financial plan. Stress testing and using these types of simulation tools are areas where I would certainly recommend working with an advisor. There are some free tools available online that allow you to look strictly at just the impact of volatility on an investment portfolio. But since retirement planning is sort of an integrated practice or an integrated discipline, I do recommend running these stress tests in conjunction with the rest of your financial plan to determine the sustainability of your retirement portfolio. Now, I do these tests as part of my onboarding process with new clients. If you're interested in more information about that, there's information below on how to get in touch with me. But if you just want sort of a one-off stress test, a one-off financial plan on a fee-for-service basis, there are planners that do this work, fantastic planners in Canada. If you're interested more in that type of approach, just send me a message and I'm happy to connect you with one who is highly qualified to help you in these areas. So that's all I have for today as far as the stress test component of our video series goes. Now let's take another peek at our agenda and see where we've come so far and see where we're going from here. We've covered objectives, the ability, willingness, and need to take risk. We've talked about the importance of asset allocation. I've talked about my very unique and simple 2-bucket system to retirement income portfolio management. We talked about stress testing your portfolio. In the next video, we're going to talk about active management versus passive management. I'm going to define what those terms mean and talk about the different ways you can invest your portfolio. Big investing mistakes that I do see and I like to sort of warn people off of if possible. I'm going to talk about big mistakes. And then we're going to close the series with some advanced strategies at the very end. So again, thank you for watching this video all the way to the end. If you did like it, do give it a thumbs up. Make sure to subscribe to the channel, hit the bell icon so that you're alerted when new videos are posted. Leave me any questions or comments below. And if we don't speak, I hope that you have a fantastic rest of your week. And I'll speak with you soon. Take care.